And initially it started as an institutional product, right? It was index based, an easy way for institutional investors to access something that replicates an index, so index exposure, without the high cost and operational hurdles to replicating an index yourself, right? So you outsource all of that, uh, and you buy an exchange traded product, which comes with all the benefits I already mentioned, right? And that was kind of how it started. And then over time, uh, the industry figured out, well, we can also provide access to new markets geographically, right? So harder to access capital markets. Korea, Malaysia, for example, are great examples. Well, if we can wrap the S&P, we can wrap other indices which are harder to access, and not only geographically, but we can also wrap other products. We already talked about ETCs. We can talk about corporate bonds as well. Like those aren't super easy to access, right? If you have them in an ETP structure, all of a sudden the game changes, right? And it means capital can much more easily flow into these assets, and you can get the exposure that you're looking for. And over time, the initial story the ETF industry told was, and this probably happened after the financial crisis, which was actually probably a linchpin to another increase in the growth rate, right? Because obviously you had some like structured products which didn't go so well, and it triggered obviously a lot of consolidation in the space. And one of those big consolidations was actually BlackRock buying BGI, which was the owner of iShares, which is the biggest ETF brand on the planet, right? So that was kind of something that increased the pace of growth and increased the adoption of ETFs. And the story we told was, okay, you can now have something transparent, because people were looking for transparent alternatives. But also we started telling the story of the passive index tracker, which has very low management fees, is going to beat over time the active manager, which is very, quite ironic with today's framing, because active ETFs are becoming so interesting. So just to like finish my thought in terms of the story of why ETPs are becoming so important. So not only 2008, but we also had COVID in 2020, and we all know what happened in COVID, right? It was the rise of the retail investor. Everyone and their dog opened a brokerage account and started trading, and we all kind of thought that would go away, but it hasn't. And the retail investor is alive and well and looking for products with these characteristics, or a way to invest that's quite easy, accessible, transparent, etc. And there's another stat I looked up just before joining the call, actually, which I thought was really, really interesting, on the awareness gap, right? In line with the theme of the retail investors, something like 64% of UK adults don't know what an ETF is. And that missing knowledge is much more pronounced in the older demographic. And it's the under 35s, which are actually adopting ETFs and have the most knowledge of ETFs at the moment. And this comes at a time when demographically, especially across Europe, but also in the US, you're going to have a big transfer of wealth. So this is, you kind of have a confluence of things, new generation looking at these products